Good afternoon and welcome back to the InvestTalk Market Analysis for the week ending February 9th, 2024. Appreciate you all tuning in to this channel, liking and subscribing, as well as to our podcast, InvestTalk. I'm host Justin Klein, and today I'm going to title the video Options Buying Drives the S&P over 5,000, but is the peak near? We're going to talk about that. But let's dig into the economic data real quick. And the big news was really on Monday, and the ISM services PMI, which strengthened, and you can see the components that did well. So prices paid were up, so that's one issue. That's certainly going to strengthen the Fed's resolve to defer any rate cuts till probably the second half of the year. Right now, I'll pivot over here real quick. The June odds are basically of between one and two cuts between now and June. And June's still technically the first half of the year, but that's probably where I think the first rate cut comes. But and that's mainly because of this. The prices paid index is likely to keep inflation sticky. We said that for a while that uh, the inflation data, while improving, is not going to improve as nearly as dramatically as it has over the last year. It's going to be a slow, tough slog to get down to that 2% target. So I wanted to touch on that because that's probably the most important piece of macro data that came out this week. The employment index that also strengthened as well. The 50, we had the jobs number last week that showed better than expected job creation. Now there are a lot of layoffs in the tech sector and finance and things like that, but the services, that's typically your bread and butter um, daily businesses, and so that strengthened. So it's no longer shrinking. It was deeply negative territory in December. So some of this is just a snapback. Maybe this is an anomaly, right? So if you kind of look at it from November, it's roughly flat. Okay. So the jobs market, I still think we're in kind of a neutral jobs market. It's not great. It's not bad. It's a steady state for the most part across the board. Obviously, there's pockets of weakness, pockets of strength, etc. New orders did increase up to 55. Once again, anything above 50 is growth there. So ISM services new orders that did strengthen. The initial claims for unemployment, this is the 4-week average, and I try to focus on this. If you're ever looking at unemployment claims, you always want to look at the 4-week average because there can be a lot of noise week to week. But what you can see here is now the 4-week average has ticked up for 2 weeks in a row. So that looks like it's headed to the upside. And then continuing claims. This did have an improvement this week, 1.87 million jobs down from 1.89. But what you can see here is from early January, this has accelerated to the upside. So do we get a breakout here? We shall see. But you can see once again, uh, basically this was heading higher up until the fall. You had that good inflection of, hey, the Fed was going to pause, financial conditions eased throughout the latter part of the year, and that's kind of stuck. But it's not improving, right? It's not this downtrend like we saw in the spring and into the summer of last year, kind of post the banking crisis. This is now just kind of moving sideways, which it tells me that, yeah, financial conditions have eased a bit, but it's not having a large impact positively on the jobs market. It's just kind of stopped the jobs market from deteriorating further. So will there be any uh, if there are any future changes to financial conditions where they tighten, that can mean a breakout in unemployment and actually trigger that recession. So I do think that we are headed there, but kind of in a steady state pause until there's some sort of catalyst for that. And it could be liquidity drying up for various reasons. But obviously, markets at new highs. And I wanted to highlight this, and that's why I talk about the options market. And this is a great post. This is from the chief strategist over at Interactive Brokers. Now, Interactive Brokers, they have a pretty strong contingent of active individual traders and options. And what he talks about here is just how important those zero DT options, 0 days till expiration options, were or are now in the market. And basically, what happens is it creates a gamma squeeze. A gamma squeeze. This is what at the end. As you ask yourself, have you ever heard the term gamma squeeze prior to COVID? Yeah, a lot of what's happening in the market when you see upside, especially in those big tech names, is a gamma squeeze. A lot of speculators in those big names, and as you get closer and closer to the option expiration, then that's when you get uh, that gamma squeeze even more. Um, and next week is option X week, and so that's something that certainly needs to be uh, in consideration. Okay. And that's probably why you get a float up into the end of next week. And oftentimes you can see that break to the downside post op X. So that's what I'm kind of expecting. The markets are very overbought. The big tech names that have done well recently are very overbought, especially the Nvidias of the world. And uh, they can have a quick and fast sell-off if you get that gamma squeeze unwind, meaning it's called a negative gamma situation. Right now we're in positive gamma. When the markets are in uptrend, that tends to be what it is, positive gamma. And the big question of whether you get a modest pullback or a major pullback has to do with whether the market flips into what we call negative gamma, where those that option positioning actually feeds on itself in a negative way. It's reflexive in a negative way. So it is reflexive both ways, but you typically do need some sort of a catalyst to spin it out of one direction or the other. We were in a negative gamma situation late summer last year, and that flipped with the Fed pausing. And now, what's the catalyst for that to flip again? So I do think there will be major volatility this year. Big downdrafts, big updrafts. Right now, we're in the midst of a large updraft, and so the the Fed probability of a Fed rate hike, or excuse me, cut, continues to be pushed off. By year end, it looks like you're pricing in about 4 to 5 cuts here, 4 to 5 cuts right now, even though the Fed is still talking about 3. So let me run over to the charts here real quick and talk about that the RSP. This is the equality index. So you can see this is things. Markets are uptrending, but they're not as strong as the S&P is kind of implying. It's a very narrow rally driven by those big tech names. And so, do you want to chase the gamma squeeze? Maybe if you're a short-term trader, but know that this can reverse rather quickly. And you saw that back in July, August. This catalyst was really the Treasury issuing more debt, long-term debt, pulling liquidity out of the market, and that brought that pullback and also seasonality as well. Now, March is typically the time, the Ides of March, that's typically the time where you get more market volatility. But maybe you start that early after this option X that's coming up this week. So something I'm watching out for, and just that once again that lack of breadth here, the RSP. Look at this divergence here on the MACD, and so uh, you know, th- if that gamma squeeze goes the other way, that means the unwind in those big tech names, the Nvidias of the world, Microsoft's, Google's, that oftentimes draws some that can reverse, like I said, rather quickly once the gamma squeeze or gamma situation goes into negative gamma. I know it's complex. I know it can go over a lot of people's heads, but basically, what it means is there's more positioning on the long side, buying calls in particular names. It feeds on itself because the dealers have to buy the underlying to hedge their risk on the upside. And so, as more and more people buy those options, and that's why I talked about the DT options over here, this kind of feeds on itself and becomes reflective. So I wanted to highlight that. Let's look at the credit markets. You had the credit markets holding in there. Here's SHYG to SHY, so short-term junk to short-term treasuries. That remains strong. but you are getting a MACD divergence here, so something I'm on watch for. The dollar, that one got strength really throughout the week, but it's not really falling through the upside. With what's interesting is the incremental change of the Fed expectations of rate cuts um, hasn't really strengthened the dollar very much. You look at a month ago, and you've obviously seen the Fed talk hawkish, push those rate cuts further out, and the dollar strengthening, but not in a dramatic way. It's very minor. So, uh, to me, that shows relative weakness, and with our debt situation, I can easily see this rolling over. And that could be a catalyst. That could be a catalyst for money moving out of those big tech names and into say the value side of the market, commodities, which continues to be kind of down in the doldrums. Here's the commodity index that remains fairly weak, and it really is all about China. China is really the news. They're trying to juice the market higher, but ultimately they have more problems, and that's not going to be resolved anytime soon. They have a giant real estate bubble that is coming undone, and I think that's only going to continue for the foreseeable future. Still an uninvestable market. you know, Look at Baba with all this juice, it just remains in a downtrend. So I see that as weighing on global growth most of all. Let's see, what else do I want to get to? Oh, the 10-year. Let's take a look at the 10-year. We are seeing higher rates, just kind of grinding higher here. I do think the risk to the 10-year is to the upside, mainly because of the still massive supply of issuance this year. About $20 trillion in gross issuance. Now, a lot of that is debt that's expiring, right? T-bills, but 20 trillion is still a lot. And net new issuance is about 6% of GDP, about $2 trillion. So that's a lot of balance sheet capacity that people need to have. So I still think the risk is the 10-year heading to the upside. What else do I want to get to before we close? Let's take a look at the NYSE. That is a much more broad index than the S&P or the Nasdaq. And what you can see here is just we're testing the highs. And what I actually expect is this to continue to be in a very choppy pattern over the coming years. So I think we're at the high end of the range. It doesn't mean there can't be more upside, especially on the S&P. Could we get to 5,200? We're at 5,000 now. Here's the SPX, closed at 5,026. And could we get to 41 or 51, 5,200? I think that's very possible. But what is the next catalyst for that move down? And I think you will see a more significant pullback because of how overbought the markets are, the and the gamma situation that could flip based on any real catalyst. Take a look at the move index. This remains very subdued, so nothing. The recent auctions in the treasury market have been very good, so that's not really an issue. The VIX is low, so not a whole lot. Everyone's selling vol, they're not buying vol, and that has kept volatility in check, and thus you kind of have float up in markets. Uh, let's see if there's anything else I want to get to. Oh, yeah. Let's take a look at the growth to value trade. So this is very interesting. This violent move to the upside. Once again, I think this has a lot to do with that gamma squeeze. But what I'll be watching is, does it break this high here? Do we make a series of now higher highs? This is a higher low. Do we get a higher high? Which is something I'll be watching in the coming weeks. And I think that about does it. Near term, I would say I'm neutral to bullish, especially next week. But as we get into the end of February and into March, I think there could be catalysts that could trigger a pullback. But we have to be on the watch for that. We have to see a day. I'll show you this. Let's go to the daily chart. what you can see here is if you go back to June, you had this wide-ranging reversal bar, and the market hung in there for 3 days and broke lower, and you had follow through. So that's what that's what you're going to need, right? You had one a day here, but you had no follow through. So until same thing with this, right? Sell off here, float into kind of year end, a little bit of sell off the first couple of days of the year, and then we've just gone higher since. So, I think you would need a reversal again, and then an actual follow through to the downside before you can say that negative gamma situation could be in play. For right now, positive gamma into option X likely means a float higher. All right, I think that about does it. I appreciate you all tuning in and liking and subscribing to this channel. A reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.